All right, today we've got a real financial puzzle for you. Get this, a company starts spending way more money than usual, and then, somehow, has its most profitable quarter ever. How on earth does that work? Let's dive in and solve this thing.
So this is the big question, right? How can you ramp up your spending, but then end up with more money in the bank than ever before? It just doesn't seem to add up. It feels like a total contradiction. But the answer? Well, it's all in the details.
And here are the two core facts that are seemingly fighting each other. On one side, the company's operating costs skyrocketed to $250 million. But on the other side, profits in that exact same period absolutely shattered all previous records. So what is going on here?
Okay, so to figure this out, we've got to follow the money. Let's start with that big spending number and unpack exactly where those extra costs were coming from.
And yeah, the numbers are pretty stark. In the second quarter of 2024, costs were at $217 million. Fast forward 1 year, and they've jumped to $250 million. That's not just a small bump, that's a serious jump. So one side of our puzzle is confirmed. They were definitely spending a lot more money.
So when you see a number like that, you start asking questions, right? Is the company in trouble? Are they just burning cash? Well, this is where we find the first major clue to solving our puzzle. And bam, here's the answer. This wasn't a problem, it was a plan. The company was on a buying spree, making a series of strategic acquisitions. So they weren't just spending money, they were investing it.
And this wasn't just a one-off thing. Look at this timeline. It kicked off in 2024 and then really ramped up in early 2025 with some huge names. Now, think about it. When you buy a whole company, you don't just get their logo, you get their bills too. You absorb their payroll, their rent, the whole shebang. And that is exactly where that massive jump in operating costs came from.
Okay, so that explains the spending more part of the equation. But what about the making more part? Let's flip over to the other side of the coin and see how this all paid off. Now, before we throw some big numbers at you, we got to quickly talk about a term you're going to see, adjusted EBITDA. I know, it sounds super technical, but the idea is actually pretty simple. It's basically a way to measure how profitable the company's main day-to-day business is before you factor in weird one-time expenses or taxes. It's kind of like checking the engine's health without getting distracted by the shiny paint job.
And let me tell you, this company's engine was absolutely roaring. Their adjusted EBITDA shot up by an incredible 63% compared to the year before. That's not just good, that's a new company record for a single quarter.
And this chart just makes it so clear. I mean, look at that jump from $77 million to nearly $126 million in just a year. That is the payoff we were talking about. This is those new companies adding their profits to the pile. And what's wild is, this isn't even the best part of the story.
For that, we need to look at something called GAAP net income. Okay, so if EBITDA is the health of the engine, net income is the final number on your paycheck after all the deductions. It's the bottom line. It's the actual cash profit left in the bank after every single bill has been paid. This is the number that really, truly counts.
So, you ready for this? The company's net income exploded by 90%. 90. That's almost double what it was the year before. And yeah, you guessed it, another all-time record, completely smashed.
I mean, just look at this graph. They went from about $21 million in profit to nearly $40 million. They practically doubled their take-home cash in just 12 months. And remember, this all happened while their spending was going through the roof. The puzzle is starting to make sense now, isn't it?
All right, we've seen the spending, we've seen the profits, we have all the clues. Let's put this puzzle together once and for all.
It really just boils down to this simple three-part story. First, they went on a shopping spree, buying up other companies to get bigger. Second, because of that, their own bills went up. That's the increased cost. But third, and this is the magic part, all those new companies brought their own revenue and profits with them, leading to that record-breaking payday. And there you have it. Puzzle solved. The takeaway here is huge. Not all spending is created equal. Sometimes you really do have to spend money to make money. And in this case, spending big on smart strategic growth wasn't a liability. It was the most profitable thing they could have done. So Q2 was obviously a massive win for them. But it does leave you wondering, right? This kind of aggressive growth worked like a charm this time, but can they keep it up? Is this a long-term winning streak or just a one-hit wonder? I guess we'll just have to keep an eye on the next quarter's numbers to find out.